Good afternoon, everyone. On behalf of IVCA, I'm delighted to welcome everybody to another edition of our IVCA What's Next webinar series. Today's discussion focuses on private credit in India from alternative to essential capital. Moderating today's discussion is Raja Ajwani, partner, Deals, PwC India. Joining him on the panel are Anupam Goenka, managing partner, Ascertis Credit Group; Apoorva Sharma, Managing Partner, Stride Ventures; Monu Jain, Partner, Aavishkaar Capital; Pranab Gupta, Managing Director and Business Head, India Alternatives at Lighthouse Canton; Rahul Shah, Partner, Kotak Alternate Asset Managers; Rubin Chera, Managing Partner and Head, Special Situation Strategy at Neo Alternative Asset Managers Private Limited; and Umakant Panigrahi, Managing Director, India Leader, Valuation Advisory Services at Kroll. Thank you all for joining us today. With that, I will hand it over to Raja to set the context and lead the discussion. Over to you, Raja.
Thank you, Paramita. Very good afternoon, everybody. A very warm welcome to our esteemed panel members and all the participants to the discussion on private credit in India today. Look forward to moderating this session with a panel, an esteemed panel of over 100 years of experience among panel members. To start with, I would like to share private credit in India has reflected a healthy growth in deal value of over $12 billion in the last calendar year. It presents an excellent opportunity to investors and investees alike, with financing solutions spanning across refinance, acquisition finance, and various other customized solutions in the real estate, energy, industrials, healthcare, and pharma and new age sectors. Participants in the space remain cautiously optimistic to bullish in the short to medium term. With that backdrop, I would now like to open the panel discussion and start by inviting Rubin to share his thoughts on market dynamics and deployment trends in private credit in India versus the rest of the global markets.
Thank you, Raja. Thank you, IVCA, for organizing this and also creating more awareness around the asset class. So, very important question. I would actually like to make a case that India private credit currently is best placed from a risk-reward perspective. Now, why do I say that? And quick comparison between, say, the other key markets. So let's look at US, for example, which is by far the biggest market. So US currently, total market size would be about 2.5 trillion, 600 to 700 billion odd annual deployment. Comparatively, India is in a very niche stage. We are in a very early stage of evolution. We are right now, say, around 30-35 billion kind of total stock in the market, and say about 10-15 billion kind of total annual deployment. Now, coming to quick comparison, so if you look at US market, typically private credit deals go up to 6x leverage. There is also fund level leverage on the private credit funds over there. Market is very fancy. There is a lot of slicing. There is senior, junior, mezzanine kind of tranches. Because the deals are very well cooked, the deals are typically low on covenants. They are low on collateral, and lot of exposure on tech and AI. Comparatively, if you look at India, deal leverage, most private credit funds around, I see the leverages are typically below 4x debt to EBITDA. We do not have fund level leverage. Most deals are simple senior lending. Because our deals are not very well cooked, intermediaries are not very sophisticated. So deals are bilateral. And because of that, our deals are typically quite heavy on covenants and collateral. And also, we have very low exposure as a country on AI and tech. So that's a key differentiation between us and US. If you look at our Asian peers, if you look at, say, Indonesia, Australia, very heavy on commodities. If you look at Vietnam, the lending is typically concentrated around 15, 20, large family-dominated corporate groups. Singapore, very heavy on sponsor funding. But if you look at Indian market, we are very well diversified. We have exposure around on 10, 12 different sectors. We are investable corporate underlying market would be across, say, 3,000, 3,500 odd corporates. So it's a very well diversified, very deep market. So sorry, it's a slightly long answer, but that's how I will bring out the nuances of Indian market vis-a-vis our global peers in private credit.
Thank you so much, Ruben. This is really insightful. If you could also share some thoughts on the agility and structuring flexibility in the financing solutions that private credit brings vis-a-vis banks and NBFCs, and the key differentiator that it creates for its investees.
Got it. No, very good question. Very, I would say, on the money question. So see, over the years, and I've spent a lot of time in private credit. I've been in the industry since the market started, pretty much. Earlier, private credit was viewed as something fancy, more holdco level, promoter level transactions. And private credit as an industry was pretty much doing, what RBI used to not allow banks to do from an end use perspective. Over a period of time, especially post-COVID, private credit is now slightly getting mainstream. It is getting very much acceptable amongst the various stakeholders in the industry as a prominent financing solution asset class. Direct lending has now emerged significantly. So instead of doing holdco promoter level transactions, a lot of deals happening in the market of late are direct lending transactions. And that's mainly because now promoters are increasingly open and increasingly seeing this, not as risky, expensive lending, but more as flexible, solution-oriented, and somewhat bridge funding. So I think that's something that has emerged over the last few years.
That's helpful to understand, Ruben, and I believe this will just give many more opportunities to the space as we get into the current situation and the opportunities that the current global turmoil actually offers. With that, maybe I would like to now invite Monu to share her thoughts on emerging opportunity landscape in private credit, particularly also shift towards new age sectors, and also importantly whether private credit can increasingly act as patient capital for mid markets, mid corporates, and SMEs and underserved businesses. So maybe over to you, Monu, for your thoughts on that.
So thanks, Raja, and thanks IVCA for hosting the webinar. I so required for creating private credit awareness. So I just want to give a little bit of context on what's happening in the world before we jump to the emerging opportunities, because the world today, as we see, is not what it was a year back. We have a war with West Asia. The Ukraine war had been going on for so long, and now we have this war with West Asia, which has captured the Strait of Hormuz. India imports 85% of its crude oil. The crude has jumped beyond 100 per barrel. Inflation is going up in India. It was 2.6% in FY26, but FY27 is projected to be 4.7%, a direct reflection of the cost of energy, which is seeping into everything that we buy, that we produce. Logistics costs are going up because of the blockages. Transportation is taking 10 to 15 days more, leading to higher working capital requirements, higher transportation costs. The other thing that's happening is, India's demand, India's GDP has been totally, the GDP growth has been reduced to the projections from a 7.5% last year, 7.6 to be exact, to about 6.7%, because it's a ripple down effect of the other big factors that over the last year India has faced, and a lot of countries, is the tariff uncertainty from the US. The flip-flop has created so much uncertainty for businesses. With the peak of 50%, so many SME businesses, other businesses try to diversify into alternate markets, products, and create alternate venues. And then there's a reduction, and now there's again an increase being discussed. So there's this total lack of uncertainty with India's biggest export partner. So India is not immune to all this, even if we know we have a large domestic engine for consumption. But it's not doomsday. I think the third biggest lever that's happened in the world over the last 1 year is the unprecedented surge in AI. There has been a huge, gigantic shift in valuations and allocations of capital to AI and AI infrastructure companies. I mean, I just want to share some statistics. The top 15 tech AI companies of the world have valuations of about $35 trillion today, which, if you really ask me, and it's grown by 50%. And a single company, NVIDIA, is a $5 trillion, which is larger than India's GDP. So, and we have more like that. So that's the extent of the shifts that have come about. And it's not just US. Now we have the Korea, SK Hynix, and Samsung that's come up, TSMC from Taiwan. So globally, this is now emerging as one big shift. But having said that, now with this context, it's not all doomsday for India, but it's very important for us to look forward, look ahead. The AI infrastructure demand has created a lot of emerging demand in India on data centers, on semiconductors, chips, and all allied industries like power, cooling systems, your cables, all of that. So if we want to break it down, data centers cumulatively had an investment of about 20 billion in India over the last 5 years. And in the last year itself, $65 billion have been committed by the big Amazon, the Amazons and the Googles, right? So there is this huge demand for setting up data centers in India because of the availability of land in India, because it's cheap right now. We're pretty much 50% of the cost of what it costs to set up a data center in Asia. And of course, the other big factor for that in India is India's own domestic demand. Our internet users today are at about 970 million people. Our data usage has tripled over the last 7 years. So all of this comes the need for data centers. And I'm sorry, I'm giving a long context and a long answer. But what it does for SMEs, and which is where I think is the real emerging opportunity for private credit, because the big names will get captured by the big bosses and the banks, and you'll have foreign institutional capital which will come. But at the tier 2 and the tier 3 level, a data center will require precision engineering, they'll require mechanical, electrical, plumbing, they will require specialized cables, and this is where our SME players will be. The other big player will be your semiconductors. Now, of the 5 trillion that I spoke about, the top 15, 8 are semiconductor companies. Now, when these semiconductor companies, and India has a big focus on electronics manufacturing, it's one of the PLIs. We've seen a big set of Apple that has come in. And so with that, what we are seeing now is that the semiconductor investments are expected to grow 30-40% over the next few years. And that trickles down to SMEs for, there's something called assembly and testing of semiconductors, for example, that requires specialized smaller companies they can't manufacture the wafers, but who is going to fund these smaller companies, right? The chemicals that they need for packaging, these small consumables for testing. Then the other big trend that we are seeing is the need for power to fuel this entire AI and computing requirement, right? Now, every gigawatt of a data center requires at least 3 to 4x of power to fuel it. And of course, cooling systems and water. And where does that come from? I think the easy answer for India is renewable energy. The energy transition is so critical for India because right now it's the hardest thing you see on your face, because the crude is at 85%. It's hitting India. And it's a national imperative to switch to renewable. And we've already done about 40% of our capacity is solar right now, although actually utilizations are lower because of battery restrictions. And so the on the solar, the OEMs, the manufacturers, the backend, the tier 2, tier 3 is where private credit opportunities are arising. And in fact, this we've been seeing for a while now. EVs itself, for example, also part of the energy transition, has grown by about 25% last year. It's had a bit of setback because of the charging infrastructure in the initial years. But now we are seeing that India, especially in the two-wheeler, is forging ahead, and who does their components, all of that. So this is where and this opportunity on a very back of the envelope is sized at about 40 to 60,000 crores for private credit, because banks are not coming to fund these. These are smaller companies. They are scaling up very fast. They don't have historical track records. The pace at which they need working capital is much faster than what they've done in the past. So banks will be there maybe for a basic level, but to fulfill the new needs, private credit steps in. Plus, a lot of this, if you see, is in the supply chain, which essentially means that the companies will be sitting on orders. And that's what private credit can fund more comfortably, because your visibility of cash flows, even if there is the assets are a constraint. So yeah, data centers, semiconductors, energy transition, and the trickle-down effect into specialty chemicals, specialty manufacturing, MEPs, cooling systems, HVACs, power cables, in a nutshell, with strong opportunity over there, 40 to 60,000 crores over the next 3 to 5 years.
Thank you so much, Monu, for a very, very granular response, duly correlated to the global realities. So clearly, this is a big propeller in terms of the opportunity going forward. So there's more to fund clearly with agile solutions. With that, I would now like to invite Pranab in terms of sharing his thoughts on the factors that are driving private credit's shift from an shift and acceptance from an alternate finance provider to growth capital provider. And also maybe, Pranab, if you could touch upon retail participation in private credit and the enablers that could, support this growth going forward.
Sure, and thanks, Raja, and the IVCA community for inviting us to share our views. And good morning, good afternoon to my fellow panelists. The case for private credit in terms of the attributes of the product itself are well made, right? And some of my panelists have made them and are to speak on them, sort of in the course of this discussion. I want to touch upon very specifically the question in terms of shift and acceptance. I believe one of the reasons for, the acceptance in the sense of, just an empirical figure, 3 lakh crores in terms of basically the CAT 2 AIF as a category, growing to about 10 lakh crores, give or take, right? One of the biggest reasons for the acceptance has been essentially that the fund houses, which are sort of chipping away at this, old and new, are starting to get into basically their second, third, fourth vintage of funds. So what is happening in the asset classes, you suddenly have an actual asset management track record, which is demonstrable. And one of the big reasons for this is, and I think I speak for the community, that while I market, or while we market, let's say, funds with typically 5 years, 6 years, 7 years duration, the reality is that, if your credit calls are right, you tend to get back money in 2 to 3 years, right? In terms of a modified duration, I would say, broadly speaking, right, it would probably be in the 2.5, 3 year range for most of our exposures, if you've underwritten right, of course, right? Which means that from an asset management track record perspective, private credit has probably had an easier journey than, let's say, private equity in terms of demonstrating a consistent performance, right, in terms of returning money to investors and then calling upon, to a great extent, the same investors or, like-minded investors, right, in terms of drawing upon the next, basically series of the launches of each of these houses, right? The other point to make with regard to, the shift and acceptance, part of it is a little bit of, I would say, capital supply side driven. Post the kind of QE that we have seen sort of concurrent to COVID, right? Effectively, we've been sort of in a continuing low interest rate environment. So if you look at basically a sort of, broader fixed income and credit play in terms of getting a premium over fixed income, okay, it's been a bit of a difficult journey insofar as getting it in the classical rates market is concerned, right? And in comes private credit with sort of secured, collateralized lending, usually to good, well-proven counterparties with zero history of delinquency, right? Where you're trying to basically sort of lock into a non-bankable end use, right? Not into a elevated level of risk. And that's been sort of, I mean, from a timing perspective also, in a slightly, I would say, moderated or benign interest rate environment, right? Been a compelling product. Which brings me to the point of retail participation, of course, right? The biggest reason for participation, I mean, ultimately speaks to demand, right? I mean, demand from a perspective of having that discretionary capital. At the end of the day, you have created a closed-ended product, and you have created a product where the minimum check size is 1 crore. So it's not inconsiderable, right? It's still a fair deal, right? 6 years, 1 crore, and so on, right? So where did this wealth come from? It has come from the buoyancy in the capital market, right? Effectively, the kind of slew of basically the new age economy which has come up, some of the sectors that some of my fellow panelists have touched upon, slew of exits in both private and public markets, the most buoyant capital markets that we have seen in the history of India, have created basically the kind of surplus discretionary capital that has looked for new avenues of investments in things that they already understand. So apart from, of course, looking outward, right, which of course has its own sort of dimensionalities, capital controls, and other such, right? The reality has been that if you understand Indian healthcare or Indian consumption or Indian financials or renewables or what have you, right? Private credit has given an interesting dimension to work on some of those things, even in groups wherein, you know, anecdotally equity would be expensive, to put it very simply, right? If you wanted to participate in X group in healthcare or Y group in consumption, there's maybe no way then that bespoke trade that one of us is sort of showing to you or is sort of booking in one of our funds, right? The other part about retail participation and just trailing off with that is the guardrails, right? Of course, we've had a very busy regulator, right? And all for the right reasons, right? In terms of, I mean, of course, the closed-endedness is well understood, but in terms of being very circumspect about the minimum threshold, and I would say sort of uh, toggling it where, basically there are grounds for doing so, accredited investors, SIFs, what have you, right? But again, having limitations around each of those categories, right? Valuation related guidelines, winding up related guidelines, right? We haven't reached a stage where we have like a effectively a, I would say, a perfectly sort of labeled sort of public market product. But then you also need that delta, right? Ultimately you are speaking to a degree of arbitrage with the public market, right? You are talking about bespoke situations, so some degree of delta will remain with regard to private markets. But I think, I mean, increasingly my peer group talks about rating their funds. Okay, we talk about doing more and more rated listed papers. I think increasingly the direction is towards transparency. Transparency tends to compound faster, right? Opacity tends to give you more short-term returns, but over cycles of fundraising and deployment, you tend to get stuck somewhere or the other because something that you sort of probably didn't sort of budget for went sideways, right? On the other hand, getting into a framework where the I would say the recipients, the HNI family office community, the institutional investor community, right, has a much, I would say, simpler understanding of what we are dealing with, is helping the growth of the asset class a lot, right? So yeah, I mean, these are at least my key points, Raja, if I may.
No, this is really, I would say, good to hear that with the transparency, with the risk appetite improvement for retail participants, clearly there is going to be one more clear source of capital, so to say, and over a period of time, hopefully it becomes patient capital. So thank you for that. Thank you, Pranav. I would now like to invite Anupam and Apoorva for their thoughts on essentially policy interventions that could help institutionalize private credit more, enhance the institutional participation, and also maybe some thoughts on regulatory treatment and risk return considerations as this journey goes ahead.
Yeah, if I may. Yeah. Thanks, Raja, and thanks, IVCA, for organizing this. Raja, just to answer your question, right, before we get into policy interventions, I think the key to understand is, right, from our perspective, we are already seeing that the private credit market has seen a huge transformation, right, from just a niche asset class to a more institutional mainstream asset class, right, of the last decade or so, right? And why do we say so, right? Effectively, if you look at the deal activity, like some of my colleagues have spoken about here, right, there is a significant deal activity that has increased over the last decade or so, and more so, I think, post-COVID, right? As the demand for capital has increased, banks have had their own challenges in terms of, providing all of this growth capital, and that's where the private credit has stepped in and provided that capital. Second thing is that I do feel that private credit as an asset class is not really trying to compete with banks in that context, right? Our belief is that private credit solutions are more complementary to banking products. Banks can do certain things in terms of providing regular working capital and non-fund based limits and everything else, which typically the businesses do need. But private credit comes in and provides bespoke solutions, right, which effectively today the banking ecosystem is not really designed to kind of support. Third thing from a institutionalization perspective is the fact that you are clearly seeing the increase in the number of private credit managers, right, effectively. And if you actually look at last 5 years or so, right, the number of AIFs, right, especially Cat 2 AIFs offering private credit solutions have increased dramatically, right? And that's clearly a sign of increasing institutionalization of this product. What we are also seeing is in terms of the investor classes, right, effectively. And as I can talk for ourselves, right? We are on the road to raise a fourth fund, but we are seeing now there is a lot more interest from domestic institutional investors, right? We have almost about 9 to 10 insurance companies, domestic insurance companies who are now willing to, or who are now investing, right? There are, of course, the HNI space. There is, of course, more pension funds coming in. A lot of global capital is coming in, right? So there is a clear diversification in terms of the asset class and the investor base, which again is a positive sign for the sector. I think the other important thing is the fact that the regulatory architecture is evolving, right, effectively, right? We may all believe and say that, oh, we want X, Y, Z, but I personally feel that one of the things that India and the regulators in India have done is that they have been measured in terms of that approach. A few months back, we all read about what's happened in the US in terms of private credit space. And if you actually look at the comparison, today we are well insulated, right, from some of the issues that were there in the US market, right? And a lot of that credit effectively goes to the regulator in the context of, having thought through in terms of ensuring that the investors in this asset class are not typical retail investors who historically, there have been issues in terms of mis-selling products and all of that stuff, right? So to a large extent, I think the regulator has effectively ensured that, that does not happen by putting in minimum numbers in terms of the investment size. There are framework that SEBI has come out with in terms of valuation guidelines, in terms of disclosure requirements and everything else, which I think is a positive step in the direction. RBI itself, has now recently come up with with a paper allowing banks and NBFCs to effectively start allocating capital to this sector. I do feel that this journey has to be more modest and slow paced, and we do not expect this to change overnight, again, because it can bring in systemic risk into the system, which is exactly what had happened earlier, right? What banks could not do, NBFCs are doing. We don't want a situation where that what banks and NBFCs can't do, private credit is doing, right? And then brings in that kind of a systemic risk, right?
Clearly.
In that context, right, the IBC as a creditor, right, has been a very, very big positive step, right, from a regulation perspective, which is so putting all of these together, right? What I do feel that there is a significant institutionalization process that's happening in this sector. Yes, there is a long way to go, but I do feel that the regulators are doing a good job in terms of developing the sector. But yeah, I'm happy to hear Apoorva's thoughts on this.
No, I agree, Anupam. I think whatever you've highlighted with IBC and how that has evolved, the fact that SEBI doesn't allow funds to get levered, the fact that we have closed-ended funds rather than open-ended funds, some of the points that we've discussed in the earlier part of today's webinar. I think all of that has ensured that we are trying to avoid systemic risks. I would like to point a little bit about the institutional participation as an LP in the funds that can fuel the private credit, essentially size in India. So one thing is that all the institution or the sovereign money, I think is slightly focused more on equity, and rightfully so. I think it is, more long-term in nature. I would say the gestation period for certain sectors is longer. Equity is the right mechanism to fuel it. But if you look today, RDI, was a big boost for any kind of AIF participation. But in the first set, they've naturally shortlisted equity funds. And again, I'm saying rightfully so because they want to fuel deep tech, defense tech kind of companies, so that innovation is propelled in India. Anyway, India has that, reputation globally that it's probably not doing enough innovation in the tech-based ecosystem. So all of that is important. But even institutions like NIIF, SRI, they don't allocate to debt funds today, which I think they should, because there is limited sovereign participation today. If you look at it, it's just SIDBI, the fund of funds, which obviously had gotten delayed, and now funds have started applying for it. So SIDBI, of course, remains a very big plus point institutionally. But RDI, we will see how and when the debt funds qualify, and what kind of criteria fits in there. NIF and SRI, I definitely think that they should start looking at debt funds, some part of their allocation. Banks also, while they're open to participate in debt AIFs now, there was a circular in between, all of us are aware of, where RBI restricted banks from participating in debt AIFs, which has now been resolved. But even now, there are certain clauses which banks are not very clear on. So there are a couple of private banks who are not moving as fast, while some banks have crossed that hurdle of ambiguity. The other thing is the risk weights that are assigned to a debt AIF and an equity AIF, in my understanding, is the same, which essentially means that any bank or tomorrow a pension fund would look at a fund which promises a higher return with the same provisioning. So there has to be some bifurcation in terms of provisioning or risk weights that are assigned to a debt AIF with respect to holding period, IRR, DPI, certainty, etc., whatever be the metrics. But the risk weight definitely should be different compared to an equity AIF, which will make us more competitive when it comes to allocation from banks. Now, NPS has also opened up, and probably in the next 2-3 months, they'll start accepting applications. There also, I feel, segregation in risk weights will give us a better chance for debt AIFs to compete compared to equity AIFs. The other thing is, so one thing, all of this essentially encapsulates the sovereign participation and institutional participation that debt AIFs can see domestically. Even internationally, if you look, given that our coupons are distributed pretty much, say, at a monthly or quarterly level to our LPs, we become not so competitive there because hedging becomes a major issue, taxation becomes a major issue, sometimes punitive. So if something can be done on the taxation front also, I know there were taxation benefits for MLD-like instruments, but we should definitely think of certain taxation benefits from a policy standpoint, even for international participation to come in private credit funds. So those were the 2-3 points that I'd like if some policy intervention could take place.
No, thanks. Appreciate the sort of candid set of expectations out here. Maybe one follow-on question, if I can just ask. Essentially, yes, there are regulatory enablers and tax enablers that could propel things. Having said that, some of these institutions, have they, do they have the clear risk acceptance from their own standpoint to deploy any meaningful capital in this asset class? And for that to happen, clearly there needs to be appreciation of the opportunities you chase, the mitigants you place. It's not just all, like someone said, all fancy credit, so to say, right? So have they graduated to that deep understanding level, right, to really give them the confidence to deploy? Of course, as and when enablers come, they will only propel things forward.
I think they have, because again, what was being discussed, that there are multiple cycles, vintages that private credit fund managers have demonstrated, whether it is real estate, infrastructure, special situations, venture debt. There are multiple cycles that we have seen, vintages that we have seen where the funds have been fully distributed back to the LPs,
Right.
getting a mid-teen or plus teen kind of IRR on a net basis. The DPIs are healthy. There has not been extensions of fund life because underwriting has been decent. So in that sense, I think a lot of these institutions have built that comfort, and anyway all of them have a allocation strategy, and they stick to it, that this much in private markets, this much in fixed income, this much in equity. So the allocation from their private markets gets skewed towards equity if the risk weights are the same. So there should be some consideration around that, because naturally our returns won't be as high, but the risk certainly is lesser, the holding period is lesser. That has to get acknowledged somewhere in the risk weights.
Right, appreciate that. Thanks, Apoorva, for sharing those thoughts. Maybe Anupam, if I could just bring you in again in terms of sharing some thoughts around structuring, governance, risk considerations in some of the some of the situations that you finance, and what are the sort of governance mechanism and mitigants around that.
Sure, thanks. Like we all discussed, right, there is clearly more capital that's coming into that space, right? And as more capital is coming in, more asset managers are coming in, there is bound to be, more competition, right? The first natural question when there is more competition is the fact that, will there be pressure on the yield itself, right? In any market, right, when there is more supply versus demand, I think that is a natural way to go. But I don't think India is there yet, right, in terms of, the overall demand that's the capital demand that's required, right, for the growth that we are in, right? 8 to 9%, nominal growth rate expected over the next 10, 15 years. I think there is enough demand, right? So I do not naturally think that yield compression is going to be the flavor going forward as more supply of capital comes in and everyone will have a role to play. I think what's going to be critical, of course, from a private credit perspective on the structuring side is the discipline, right? Effectively. And when I say discipline today, all of us will talk about that, we all have our own internal, models of underwriting, right? In terms of, cash flow back lending, covenant heavy structures, proper enforcement mechanism, the IBC rights, regular monitoring of these investments, right? And I think there is going to be no substitute with respect to all of these, right? I think what we have to ensure that as there is more demand, as the requirement is that we don't become weaker on our discipline in terms of doing our underwriting in the way that we are doing it today. And I think that is going to be the key differentiator. One of the key things that we have seen, again, like I'll bring the context to the global markets, is that there has been too much of sector concentration, right? In the US, we had seen that there are significant sectoral concentration. So we need to ensure that our portfolios are well diversified, right? Effectively, we need to kind of also ensure that we don't get into the so-called pick structures and all too much, right? There will always be those situations, but like Apoorva was highlighting, one of the key differentiation that we are doing is the DPI, right, from a private credit perspective. And why is someone coming to private credit is because they have an ability to get a regular stream of cash flows vis-a-vis equity, where you put in the money and then you see that money after 5 years, 10 years, right? And if we move too much into the whole pick structure game, then I think while we're calling ourselves private credit, then we are again effectively getting into the whole private equity space, right? So
couldn't agree more. Yeah.
So I think situation like this, right? Collateral, right? Again, a lot of times we talk about collateral, but and we've heard deals coming to us saying, oh, this has 5x collateral, 10x collateral. I think we have to be really, really careful in the context of just that number, right? What does 2x, 5x, 10x mean, right? Is it really enforceable, right? What kind of mechanisms you have, right? Well, we also talk about IBC in a very generic context, but given the overall legal systems in India, everything is not enforceable, right? Technically. So I think detailing with respect to your real security, the enforceability of that security, we do feel that not moving away to covenant-like structure, because one of the key things to kind of do in the private credit space is not wait for an event to happen, right? It's about being proactive. So regular monitoring, ensuring that the businesses are performing the way you've underwritten. I think all of these will be critical in terms of ensuring that the asset class continues to perform well.
Clearly, thanks, Anupam, for sharing those thoughts. I think what you really articulated in terms of covenant monitoring, right? Besides, of course, underwriting discipline, which is key. I think in the kind of situations private credit finances, the covenant monitoring complexities are such that you can't have a cookie cutter solution, right? And as we grow, one has to continue to have that rigor in terms of each asset, each situation is so unique, right, that it gets proactively managed, monitored. So clearly,
Just to add to that also, I think it's also about educating the borrowers, right? Historically, a lot of times we hear the borrowers saying, "Oh, there's a covenant breach, but banks ne to kabhi nahi pucha, right? Why are you asking us if there's a covenant breach there, right? Technically."
right.
And that's when you need to kind of go and educate them that, this is not, if there is a covenant and if there is a covenant that has been agreed in the transaction document, how it's important that you understand that you need to follow it, right? This is not there in the document just for the sake of it being there. And therefore that monitoring, but also education of the borrowers, right, where they need to kind of understand that these covenants are for real and it will be tested and will be monitored on an ongoing basis.
Absolutely, absolutely. Thanks, Anupam. So maybe Umakanta, if you could share some of your thoughts on in terms of the collateral and enforcement considerations. Particularly, there has been a lot of complexity around the types of collateral that are now underwritten. There are quite a lot of non-traditional and structured collateral, right? So the practical realities around enforcements, how those are getting dealt with. And also maybe at the end, if you could touch upon the regulatory and legal enablers that could improve, enhance the recovery outcomes as well as timelines.
Sure. Thank you, Raja, and thank you, IVCA, for this opportunity. So you were right. I think I mean, before that, I think one as a consultant, I end up interacting both with GPs and LLPs, and I echo probably what Anupam said. On the discipline side, I think and consistency. As long as these days, I think investors are not only looking at a high IRR, they're looking at whether your approach is consistent, right? So that is crucial. Coming back to on the, I think collateral enforcement side. See, one of the key feature of private equity as an instrument is that it has the ability to structure the transaction in a bespoke collateral packages, right? A lot of time from lender's perspective, the critical question is not actually whether the collateral actually exists, whether what it can ultimately face, in case of recovery value, right? A lot of time, we are seeing these days, I think warrants and options are, getting inserted in your, transactions. But when it comes to type of collateral, like traditionally, if you would have seen, whether AIF or lenders, they relate primarily, tangible assets such as land, building, plant and machinery. Today, I think private equity transactions increasingly involve your shares, receivables, contractual cash flows, IPs are becoming common these days. Property rights, all these things. Okay, I mean, this certainly does create a Ravin, do you want to share something?
No, go ahead. I'll make a point after you are done.
Okay, sorry. Okay, yeah. So while this creates an opportunity, but at the same time it is complex. Reason being, unlike your public equities or let's say traditional real estate, where you can get observable market price. Whereas when you talk about I think other non-traditional assets which you are getting as a collateral, it all depends the assumption around the future cash flows, growth expectation, enforceability and recovery timeline. So that becomes probably a little challenging when you talk about in terms of collateral, what you can actually enforce. Now, as a collateral package that appears a lot of time is strong on paper, may actually deliver a very different outcome. Okay, because when you actually try to enforce, to give an example, a lot of time we know land becomes or real estate become probably a key collateral in private credit transactions. Now, let's say you're talking about an infrastructure company or let's say power plant, for example. We know the land has been given for a specific purpose. Let's say, for example, a power plant, for example, a power plant, for example, Now, if the purpose is not there because you think the company is going through stress, and because you have a collateral, you want to take control of that collateral and probably or land and give it to a commercial property, because the fair value will significantly change. So at the time of actually probably at the origination, you should see that okay, when the time comes, can you get that is the fair value of the land which can be faced. So that is, I guess, I think crucial according to me, in terms of collateral. Now you talk about regulatory or legal enabler which are available. India, of course, I think post introduction of IBC, it's a lot of change, right? We have seen. The process has been strengthened, for creditors' rights and improved restructuring ecosystem as a whole. However, if you think, that still remain opportunity where to improve some of the outcomes. Like, for example, let's say reducing the delays, increasing, capacity within the NCLT becomes a key challenge. We have seen, in fact, I've done a lot of IBC related valuation where we have seen when the company got into IBC and there is a strong, robust cash flow was there. But over the period, you have seen, the valuation of the company going down. So hopefully, I think, increase in capacity in NCLT to speed up the process, and you can actually preserve the value. Further, I guess, the development of secondary market is going to be a probably biggest enabler, because you don't want to see that, okay, hey, things are not going well. I want to either, probably look for a mechanism to probably, sell the collateral and get the value. Once we see probably a more robust or a probably established secondary market, then probably, some of these issues will not arise or wait for probably NCLT or other regulatory, framework to come and probably play in your situation. And a lot of time also what happens, let's say, to give an example, even though there is a regulatory framework, take an example of, let's say, there's a private credit transaction, or you're given a loan to a port. Okay, and what you have got a, let's say, land, building, plant and machinery as the collateral. In the moment the company goes to NCLT, the civil structure which happens to be probably 30-40% of your capital cost in a port, liquidation value is effectively zero. Like, some of these nuances also come into picture, whether when you are actually pricing the transaction, have you factored in these scenarios that, okay, hey, if the company goes into liquidation, we get actually effectively nothing, because your 30-40% of capital cost is liquidation value is effectively zero. So from that point of view, often you say that before insolvency, I mean, you can see lenders probably or investors have an opportunity to probably preserve the enterprise value, and post insolvency, of course, you're trying to discover what the residual value remains. Right? A lot of time we have seen, in fact, in high leverage transactions, let's say you have got your you've got, let's say, security or shares as collateral, but for example, let's say enterprise value goes down because one is things go south. You have seen let's say, customers, not sticking. You are seeing that, let's say, suppliers are not supporting. You are seeing, let's say, employees are not actually, staying. So in that situation, your enterprise value goes down. And that what it does a parallel shift. It does a parallel shift to your, to equity value, even though you have a, collateral package that has actually, effectively no value. So that is something which probably we are seeing, when we do valuation of, of private credit and run scenarios before, in fact, investment happens.
Right. Thanks, Amakan. Maybe Ruben, you wanted to add something before?
Yeah, Raja, sorry to interject, but since this is a very important point, I wanted to make a quick observation. So in last few years, at least what I have noticed is that there is a real fear in the minds of promoter of losing business after IBC coming in. Very small but very, very impactful nuance is that earlier it was borrower in control. So while you were in default and while there was resolution happening, the borrower was very much in control of their business. After IBC, it is lender in control. So there is a resolution agent, resolution RA sitting, and the borrower fears losing control. So it's lender in control. That small change has brought a big difference, and we have seen more and more borrowers now coming to the table much before things go very bad and things come to a default and enforcement kind of situation. So that's a quick point I wanted to make.
Absolutely, Ruben, couldn't agree more. Have seen this in more situations. There's clearly that fear of losing control, and people have promoters have seen it in action. So clearly there is that fear creating action. Maybe I think one important takeaway from what Umakant and Ruben, what you said, is essentially, just as Anupam was mentioning that underwriting rigor, covenant monitoring is important, I think baking those learnings on an ongoing basis from covenant monitoring into actual valuation reality is key. Else you will theoretically believe that there is a multiple, right, in terms of collateral margin or headroom. But essentially, as covenants breach, as the actuals fall short of the budgets or underwriting sort of assumptions, you pretty quickly lose valuation as well as marketability, so to say, right? So I think that's important for the valuation professionals as well as credit funds to very closely actively monitor. Over to you, Umakant. You wanted to make a point.
Yeah, so one, I think on the how the framework is actually evolving. I think most of us we have seen recently, US SEC, 401k, regulation, where we are expecting a lot of retail capital is going to come into AIF. Okay, and of course, most of them, because this will be retirement or pension funds, and we expect that more than equity it may go larger pie to. Larger pie to your private credit. And what is happening that this rigor, okay, is becoming more stringent, both from LP's point of view, second from regulators point of view. Now it is no more that, okay, you made one investment and you did a calibration at the time of origination, and you relook at it as an annually. Now the rigor is increasing, okay, and more frequent the valuations are actually being warranted by regulators. In fact, there are quite a few I think GPs on Somoto. I know something is there in public. I can tell. Apollo, for example, they run a pretty large private credit. So they have declared that from I think 1st of September, or I'm forgetting the exact date, 2026, they want to do a daily valuation of all of their investment. Not that those who needs to be open at a close end, because that will give you more comfort to the investor. One is your interest rate volatility is increasing big time, right? When you made investment, okay, your benchmark headline interest rate was, let's say, 5%, and in 6 months it has become 5.5%. Whether at the time of origination your headline IRR should have been 15% if your interest rate has gone up by 50 basis points or not. So I think these are certain nuances which we are going to see probably as we see it may go towards mutual fund trend, so to say, what is happening in at least in the western side.
Right, absolutely. Thanks, Umakanta, for pointing it out. Maybe in the interest of time, we may just have to move a little quickly to the opportunities that are shaping the next phase of growth. I think forward-looking perspectives are something we would love to hear from the panel. So maybe I would like to invite Rahul in terms of sharing his perspectives on which are the key investee segments and financing solution themes that are likely to dominate in the current backdrop of what's happening in India as well as around the world.
Thanks, Raja. What I would say is, I think a lot of that has been covered while we had discussed initially as to what are the opportunities for investments in private credit in India. But apart from that, generally speaking, if you see, India has seen a dramatic shift in terms of the capex deployment by Indian corporates over the last 5 to 7 years. There has been a lot of focus on manufacturing, which is aided by government incentives, focus on certain industries, which has also been supported by a significant amount of deleveraging which has happened with the corporates. So that has enabled them to be more confident to do new capex. As with every new capex, it creates its own cycle of credit. You would need capital for putting up new capex, along with some element of mezz capex if you don't have enough equity to fund those large capex as a corporate. So that also brings in a big role for private credit to chip in and provide that necessary bridge capital. There are areas where companies have now started looking at doing acquisitions, again, not just international acquisitions, but domestic acquisitions, where acquisition financing again is a continuous thriving opportunity for private credit in India. We have seen actually quite a significant amount of opportunities for investments for private credit, which are more of a rollover of the existing financing, right? And you see the whole life cycle. If the company's performance improves, you see a very high cost distress financing getting refinanced by high yield capital, and then the high yield capital over a couple of years or 3 years gets refinanced by NBFC pool of capital, and then eventually then after a full life cycle of 8 to 10 years is where you see a corporate then coming back to the banking pool of capital. So that really, it's not necessary that it always happens in a very straight fashion. A lot of times you will see a high yield getting refinanced again by a high yield, or sometimes even by a distress. So those things continue. We have also seen opportunities for investments in situations where the companies are looking to either do growth capital financing, but with the help of private credit or a hybrid credit, rather than take private equity. And this openness for Indian corporates to take this capital as an alternative to private equity has really matured over the last 5 to 7 years. They have started realizing that, look, IPO markets are not always open, and they are always open only for very select kind of high quality corporates, which means that it's not advisable to necessarily look at IPO always. Sometimes private equity comes with its own sets of high demands, which is, I want to earn at least 4x 5x in your business. I would not want you to go public in the next 2 years, right? I would want to run through the full cycle. I will not give you full value for the imminent growth which you are seeing in the next 12 to 18 months. So, these are situations which actually open up conversations for a private credit or a hybrid credit, so to speak, to provide a bridge capital. And this goes across all the sectors. So I'm more covering in terms of the opportunity sets which we are seeing on a regular basis happening in India, and these kind of ticket sizes are also meaningful for us to deploy a good amount of capital. So it's not necessarily, I think India has moved from, let's say, when 2017, 2018, when IBC was at its peak, you saw a lot of IBC resolution cases where private credit was giving capital. Since most of the large IBC cases have got resolved, or you are now left with only cases which don't have any meaningful end asset or business running. But it's migrated from that asset resolution to more of a corporate financing, to a more of a solution capital and a bridge capital.
Absolutely, Rahul. This is clearly visible, and this is, some of these pieces have been playing out, and hopefully more of this will play out, particularly in the current environment, where there have been cases of delayed listing, overdue secondary exits, refinancing, or rather maybe refinancing maturities which have not gone as expected, right? The way you said, with lower yields. Clearly, there'll be more and more opportunity for agile solutions. So with that backdrop,
can I add one more point here?
Yes, please.
Yeah, hi. Staying with the opportunities that Rahul was talking, one other thing we are seeing right now is tying in directly with the current environment is a need for growth capital for working capital finance, because there has been this huge sudden need because commodity prices have gone up, for example. So raw material need for higher raw material inventory stocking prices. As I was mentioning earlier, the transportation cost and the logistics is taking 10 to 15 days more. So the working capital needs have grown, and banks are still going to evaluate on your annual basis and whether it's stable or not, and but nobody knows whether the situation will last or when will it resolve. So everybody in our businesses are starting to factor in these uncertainties as a way of life, and hence we are seeing that need to create a buffer line of growth capital to create some stability there.
I think absolutely, Moon. This is going to be very imminent in the next. I see in the next 6 to 12 months, there's going to be a good amount of opportunities where businesses, in the long term or a medium term have a very good business profile. But given the Trump crisis, I would say it opens up situations which will need private credit solutions.
Absolutely. If I could invite Pranab for sharing some of the perspectives around the impact of the global scenario and changing world order in terms of how are we looking at growth potential. Of course, with the caveat on what Anupam mentioned, balancing the underwriting rigor and discipline vis-a-vis the growth opportunities that can present themselves because of imminent temporary stress. So maybe Pranab, some thoughts, perspectives from you on that will be helpful.
Sure. I think it's a very broad question. When I sort of looked at it, I felt that I'd sort of stick to the Indian context with regard to, sort of what it means for us in terms of headwind, tailwind, what have you, right? A couple of points I'll make here, right? And this is all empirical, right? Oil sensitivity in terms of where we are on, let's say, the renewables curve, energy transition, where we are in terms of coal, etc., right? Vis-a-vis, let's say, the last crisis and the crisis before that. Obviously, there's an order of magnitude difference in terms of the country's ability and resilience to deal with some of that. Export sensitivity. Now, there's an interesting statistic I came across, in a session some weeks back, which is that, roughly if basically India's GDP is going to grow from, let's say, 3.5 to 20 trillion over, let's say, give or take the next 20 odd years, right? Of the 14 trillion of growth, roughly about 1 trillion is expected from net exports, right? So it's really that small. So while we sort of, play it up, right? At the end of the day, obviously we stare at the falling rupee and we stare at, the balance of trade, but we just need to think about in a core consumption driven economy, what exact degree or, extent of difference or stress it makes, right? The other point that I want to make out here, right? And this is something that is very close to our heart, right? We set up funds for 3 to 6 years, right? Let's look at the crises that have actually happened. And I'm taking the public equity market as a bit of a proxy. So just, hear me out on this one, right? GFC happened in 2008. Markets came back to peaks in 3 years. Okay. COVID happened in 2020. Markets came back to peaks in roughly a year. The Iran crisis is happening as we speak, and markets are at all-time highs. We are talking about the US equity market, which is the benchmark market globally, right? So we need to, sort of contextualize in terms of, sort of a localized risk, right? A point in time temporal risk. Somebody mentioned, the Trump world, etc., right? We obviously have, midterms, etc., coming up later this year. So I'm not getting into sort of, second order effects and stuff. But my point is, when you invest for 3 to 6 years, right? The idea is not to try to hit it out of the park with sort of wild calls. But the point is, you also need to be circumspect about what has been the trail in terms of how long does a crisis actually take to exacerbate or recede, right? But again, the circumspection comes from the fact that not all crises recede, right? So if you look at, just to take a very anecdotal example, let's say CRM SaaS versus generative AI, you know which way that is going, right? So if you lean into it, in sort of the former bucket, you're not going to go anywhere probably in 3, 5, or 10 years, right? So it's very important to take those picks. Some are, I would say, reasonably commonsensical. But the only point I would make is not to get clouded by sort of a temporal circumstance, right? The other point that was made is with regard to delayed exits and longer fundraising, trajectories possibly for private equity players and even in the public market, right? Our point here is, right, I think the opportunity set is quite obvious, right? Somebody sees that there's a player, his fund is terming out, so you back the existing guy who's happy to take some leverage to buy out the other guy, and you get a nice solid LTV. So all great, right? My point is, right, and several, not just one of my co-panelists made the point about valuation and an actual mark to market. The reality is sometimes when you get into these situations, right, you have transferred a private equity problem to a private credit problem, or a public market problem to a private market problem without really understanding how to exit, right? It's a paper LTV that looks, much better and it looks lovely on a fact sheet, but you are exactly in the same place that you were, right? And yes, duration might help you, but then it may not as well, which is where the whole point of selecting between, temporal and, longer dated circumstances is so important, right? I mean, to put a simple example, right? Let's say something which is 6x levered, like 6x debt to EBITDA. And you suggest, listen, so, this is too levered. Why don't you do 2 turns of equity on this, right? And maybe a market is opening up today where some of the private credit guys are happy to do a mezz tranche or a convertible, equity linked, etc. I just wonder sometimes, right, that tranche, does it sort of speak to better liquidity, better serviceability, more exit possibilities than the 6x levered tranche, right? What have you actually changed in the fundamentals of that exit is something that's important to understand. I think duration goes a long way. A lot of the, I would say, operating metrics, intervention. For example, somebody's put up a capex and it's not played out yet. So you know that there is a proper contribution to EBITDA that is likely to play out in a very predictable manner. So these are reasonable calls, right? The unreasonable ones come where you're basically arguing for maybe converging back to a multiple which may not come back for a while, right? So it's very situational. I think that's what we hopefully do well. Yeah.
I think the last one clearly is just pushing the can down the road. If the fundamentals are not sorted, just time will not get us anywhere. Clearly,
That's been the huge problem, right? So if you look at private credit today in India, vis-a-vis, let's say, roughly a decade back, 8 to 10 years back, it used to be heavily skewed, you remember, in favor of, let's say, real estate, a lot of infra, right? I mean, effectively, you had a duration problem that was just compounding first on somebody's balance sheet, then the same guy's balance sheet or somebody else's balance sheet, right? So net, the kind of diversification we have, the depth of the capital market has helped to solve it. But I'm saying, there is a reasonable case for a certain due care, right? There is a lot of value to growing as a community, an asset class that grows safely rather than basically just stare at the rate of compounding of CAT to AIS and try to maintain that trajectory, right? So that will be my submission at least.
Right. No, Pranav, thanks for a very sort of comprehensive as well as very candid perspective on various elements for a very broad question, like you said. Thanks for sharing very pointed insights on that. Maybe Ruben, if you could help us understand in the current environment, how are you looking at global capital flows in light of currency movements and the geopolitical developments in terms of inflows, right, and, on the capital side?
Got it, Raja. So, Raja, again, a broad question, but I'll give a very specific, say, reply to this. So there are clearly two challenges. One is on the fundraising side, and secondly, if you have to, how do you think on portfolio monitoring and say underwriting for new deals? Fundraising side, Raja, what used to happen, and of late, I've been interacting with a lot of foreign LPs. So for a long period, say, let's say between 2015 to 25, rupee movement was actually quite under control. So foreign LPs had almost started accepting, say, a 3%, 3.5% as an annual sort of a depreciation in their calculations for say net dollar returns. Thanks to the recent wild movement, I think maybe there's a rethink. People will now start baking in an additional 150 bips. Say what used to be 3.5 could now become, say, anywhere from 4.5 to 5.5 as a annual depreciation. That actually 150 bips can have a significant impact because for example, performing or direct lending fund, LPs might look for a 11, 12 net dollar return. For a special sits, they might look for a 15 net dollar. So that 150 incremental currency impact can actually have a big movement, a big big impact on fundraising. So that's certainly one, I would say, challenge that has risen because of the recent crisis. On the portfolio monitoring and underwriting, definitely there is both a top line and a bottom line impact on a lot of industries. But there, I think overall as an industry, I think we've been pretty measured in terms of leverage. So generally, most funds have stuck to 3.5, 4x kind of a debt to EBITDA. So I think we are reasonably well placed as an industry. And I think most funds, and especially our fund, and I don't want to make it a neo-specific topic, but we are very, very finicky on single deal exposure. So we typically stick to our guardrails of 3-4% single deal exposure, 10-12%, 10-12 different sectoral exposure. And also, I think we strongly believe India is a plan B market. So we always keep a plan B handy. So I think those guardrails and that thought process has been handy in the current global context.
Appreciate that, Ruben. Thank you so much for your perspectives. I would like to call upon Apoorva Sharma in terms of sharing her thoughts on portfolio quality and risk considerations, and how managers are adopting to essentially origination, underwriting, and monitoring strategies in the current environment.
So again, a broad question I'll probably answer with context to the new age economy, essentially, which is where Stride comes into the picture, right? How do we underwrite tech-based companies or general startup ecosystem in general when the unit economics are just being figured out, you don't have positive EBITDA to show, and what exactly goes around there. So obviously, I think it has been discussed in this webinar a few times that debt can't replace equity, right? So we are very mindful of what are the use cases that debt can fund and what are the use cases that equity can fund. Although we don't have any end use restriction, but when we lever in terms of sizing of the total debt on balance sheet, we are extremely mindful of that. So for us, it's very important that, for example, the general metrics that we look at is debt to valuation should be less than 10%. Debt to equity raise should be less than 15-20%, which ensures that there's enough skin in the game from the existing equity investors. There's enough headroom in terms of valuation, because valuation is a game of multiples, and it can really change in a short span of time depending on whatever is happening, the FDI inflows into the country, multiple things. And we've seen massive corrections in the startup ecosystem in terms of multiples, which were at peak in 2021. It has really sobered in the last 2-3 years. And now I feel that we are growing at a very disciplined CAGR, that growth at all cost or at any cost mindset has changed. People are far more mindful of fundamentals of the business, unit economics, thinking first principles. So some of those criteria is very important. The kind of equity investors, do they have the dry powder, history, appetite to keep supporting their portfolio companies across multiple rounds, so that we know about the continuity of people in the game, their skin in the game. When we underwrite, of course, apart from the basic things, it's very important that we do triangulation of revenue. So bank statement, MIS matching, cash balance reconciliation, check bouncing, related party transactions, salary payout delays, provident fund delays, GST mapping to identify any circularity in transactions. Those kind of things have become very important for us when we underwrite a company. Our tenors are not very long. We are generally 18 to 24 months, nothing fancy, pretty much, plain vanilla EMI kind of loans with small bit of moratoriums in the beginning, largely funding capex or working capital, because many of these are loss-making companies. So we have to be very sure of, the tenors of funding, and in general, how the company looks at, their break-even path to profitability situation. And the other thing I'll say that, in the startup ecosystem, IBC is actually not an option, because if the company is going into IBC, then the only, at least whatever cases I've seen, the only real asset is the tax losses. Then people start talking about tax losses. But that's not what you underwrite when you lend to a company, right? That your asset is a tax loss that somebody will buy at, say, 5-10% of tax losses out of NCLT. So for us, proactive monitoring is extremely critical. We have to do it on a monthly basis, because in the startup ecosystem, if your business is running, it's running. As long as you're going concern, you can find value. The moment there is a default or somebody pulls the plug, as I think some of the participants mentioned, your smaller customers will start refuting the receivables. They'll say quality issues were there or timeline was not matched. The suppliers won't support. Employees will, there'll be major attrition. So it's very important that our monitoring is very proactive. And I think for all debt funds, monitoring should be is proactive, because IBC, while it can solve for intent issues and for families who have that apprehension of losing control, it's a powerful tool. But where the intent issue or losing control issue is not there, it can definitely not solve for salvage value given the timeline it takes. So in our scheme of things, our world, any resolution has to happen much before the company gets admitted into the IBC, whether it's, calling an event of default basis breach of covenants, or it is piecemeal asset sale, brand transfer, IP transfer, or a slump sale of certain parts of the businesses, which we have seen happening in cases like Go Mechanic, which is a very active case study in the startup ecosystem. In January of 2023, there was a misrepresentation corporate governance issue, and overnight the value of the asset had deteriorated so much, right? Most equity investors had written off the company within a week or so, which essentially meant that your flow value just falls like that, even if it is a good company at whatever scale and brand reputation, etc. So resolution time to act is very, very small. The window is very small. And we have seen slump sale work out where good parts of the businesses were sold to auto ancillary and auto components manufacturers, and the company did really well under their leadership, and then got sold to Spinny very recently. And everybody kind of made good their money on the debt side. And of course, people who had come in the second version 2.0 made good on the equity IRR as well. So acting very proactively, whether through a piecemeal asset sale or slump sale, whatever, much before NCLT is of extreme importance in this segment.
Thanks, Apoorva. To round it up, overall, I think we spoke right across, the expanding opportunity landscape, importance of essentially very, very disciplined underwriting, effective and proactive monitoring across the whole across cycles and over a period of time remains the key to success effectively. So I think maybe coming towards the end of the session, if we could take up a few questions that have come up on the chat box, with the permission of the panel, I would like to take a few, if that's fine.
Sure.
Yes, sure.
Yeah.
So there's a question from Divyanshu Raj. He has two questions actually. With banks now allowed to for acquisition financing, do you see competitive intensity decreasing in terms of increasing in terms of pricing, structuring, and deal timelines? And part two, how much of delta does instruments like warrants, options, hybrid instruments are adding to boost the gross IRR currently? Do you see some resistance from promoters, CFOs, while using such instruments in deal structuring?
I can pick up the second part.
Sure, Madam.
Yeah. So now I think, in the private credit, we are, seeing these options and warrants, okay, becoming more probably prominent in last, I think, 1 year or so, where I think, private credit investor is getting an option by just putting, let's say, 1%, investment, and at a valuation which is basically much lucrative. And because one, I know why they're doing, because to have some control in the company, we are not seeing that okay, investors are actually pushing that much. Okay, they think, okay, fine, no. I think one is, because private equity invest in, these private equity investor will have a probably big, deeper skin into the game. Hence, I think they're okay to probably, agreeing to such options or warrants. Of course, I mean, they are going to lose some control. There'll be dilution. To that extent, they will have some reservation, but not that it's not a deal breaker, because of this, ask from investor side.
Right. Understand.
Okay, I can take up the first part. It's a very current, recent development, and it's evolving, needless to say. But the restriction around a minimum net worth of 500 crores that has been put for acquisition financing for banks, and with a 75% maximum cap that the banks can finance, is what we're seeing is that this opportunity is being tapped for larger companies, clearly. For the smaller companies, and we focus a lot on SME performing credit. It's not a competition. However, I must also say that even for the larger companies, acquisition financing has not been the largest or a larger share of private credit per se, right? Private credit over the years has been going into a lot of creation of infrastructure, real estate, growth capital, and acquisition financing has never been a defining lever. So the real impact on the ground, while currently it's not that visible, but it's again early days, but we do expect the impact to be limited even in the larger space. And in the SME space, they continue to grow. The acquisitions are, of course, a little not that frequent in any case, but they're also below the thresholds that the banks can do.
Thank you, Monu, for that. There's another question from Meghal Lotia. The PIK perspective was very insightful by Anupam. My question is, when there is excessive capital going forward, and considering private credit agenda is to provide bespoke solutions and bespoke structuring, will the funds see more of an investment approach where there is flexibility in terms of PIK, MES financing, and pref equity, or will the funds still work with the lending approach and fund through senior lending, investment approach versus lending approach? Maybe Anupam, if I could request your feedback on.
No, sure. I think, the important thing to say here is that when we talk about PIK, we're just talking about, it's not about that every transaction or a payment in kind option is a bad option, right? That's not the point here. The point I'm trying to make here was that whenever you are looking at a transaction, you have to look at a bigger picture, right? Effectively, right? So there would be reason why a PIK structure may be required, right? Is the underlying business generating enough cash flows, right? A lot of times when you will see early stage companies or companies which are, let's say, in a capex growth stage, right, where the cash flows have not yet started, there may be a need, right, for the transaction to be structured in a manner where you put the PIK structure for the first 12 months or 18 months and then start generating or taking out coupons on an ongoing basis. So I think the point to say here is that as for each of these funds, there will be their own underlying underwriting philosophy. I think the approach would still be to look at it from an investment approach perspective and not really just a pure lending approach perspective, and look at overall all the other aspects. Having said that, a PIK structure itself is not just a bad structure, right? But will you do 100% of your transactions as a pure PIK structure in your fund? Then you are effectively going towards a pure equity return like structure, right? But yes, if you have a diversified portfolio of investments, and you have one or two underlying structures which are PIK structures because of the fact that the underlying business requires it, I think that should be fine, right? Having said that, I think that, like I said, right, we do feel that, while there is going to be more capital available, I think there is also going to be more demand available, right? So I think it's for each individual fund manager to figure out, right, what is their underwriting philosophy, what is the investment strategy on the basis of which they have raised capital, and ensure that they maintain that discipline of, following what they have effectively raised the capital for.
Absolutely. Thank you so much, Anupam,
If
for
I
your
may just
feedback.
add one point on this
Yes,
one.
please.
Okay.
Yes.
Why, it can be a useful tool, but sometimes embedding, probably, cash sweep mechanism when liquidity improves, that can be a useful tool, probably protect in the downside so that, that, okay, cash is there so that, you take it out. So that's something which you are seeing these days.
Understand. Thanks, Umakanta. The next question is from Anshul Jain. While IBC has helped improve credit discipline in India, does it really help private credit players, as many times the private credit deployment happens at the promoter level? And in those scenarios, what are the recovery mechanisms that are being deployed for enforcement? Or do you generally try and push? Sorry. Yeah. Or do you generally try and push capital in corporate structure only so that the IBC is available as an enforcement lever?
So maybe I can take this, Raja.
Certainly,
So
yeah.
clear preference always is to lend money in the operating company where you are closer to the cash flows, number one. And number two, you can then take the company to IBC if there is a bad case scenario. Promoter loans as a strategy, it will be a much smaller portion of the overall portfolio. And there the thought process is that the security has to be non-correlated and it has to be marketable. So if it is real estate, for example, it has to be a marketable real estate. It should not be like land in some God-forsaken place. And if it is shares, then the underlying company of which shares you hold should be either debt-free or having very low leverage. So we do avoid the double leverage problem. And the shares of the underlying company should also be marketable, either listed or if it's unlisted, it should be high quality, reasonably scaled up, and ability to sell in a bad case situation. If it is unlisted, there are other nuances that at least we would prefer to have a controlling majority stake, so it's easier to sell. For example, if I have a 20% stake in an unlisted company, that pretty much is useless because you can't do much with it in a bad case scenario.
That's right. That's right. Thanks, Ruben. Moving to the next question from Sanam Munod. We are seeing some portfolio companies in private credit facing exit issues. With global macro issues, does the panel foresee more special sits deals from existing portfolio companies of private credit deals?
Raja, why don't you only pick
Maybe I could request Rahul to share his perspectives on this question. Okay, I think Pranab, you would like to take that?
Yeah, sure. Happy to. So I don't know where the observation is coming from, firstly, right? Because, and I'm not trying to make a case for sort of, playing up private credit. But in general, I would believe that, a combination of, I would say, more prudent underwriting, better capital markets, and what have you, have led to a situation where there are practically no delinquency slash default, right, in private credit funds, right? Now, obviously, there is a certain opacity around data, but you will have to speak for, is the asset class growing? Are people able to launch their N+1th fund? Are those funds bigger than the previous fund? Are issuers paying back, right, in terms of public domain information? And you also compare it to basically the second half of the last decade, right, wherein basically practically every day in like the first page of every newspaper, you would see something or the other with regard to a bank or an NBFC or other such, right? So to that extent, I am not entirely aware of where the question is flowing from, right? It also, I mean, from that perspective, I think some of the panelists spoke about, right? I mean, sort of uh, I would say that alleviation or lessening of distressed debt as an opportunity, right? And a lot more movement to, I would say, growth and just plain structured credit and opportunistic lending, right? So the market has taken on a different color over time. It may be helpful to know what exactly is sort of, being alluded to by the person or persons in question, right? Because it's very hard sitting in June 2026 to point out, what is the source of alarm, because part of what we do here is to alleviate exactly that kind of alarm, right? As we speak to investors, our own LPs and prospects, right? So, happy to hear more, but not sure as to where this is stemming from.
But just to add to it, I think from a private credit perspective, I think we are in one of the most benign environments right now. Bank balance sheets are very strong. If you look at, say, the last decade or so, corporate balance sheets are strong. There is a lot of deleveraging that has happened in the whole ecosystem thanks to the post-COVID equity market rally. So in general, if I look at not just my fund but funds around, I think we are sitting on a very good asset quality and a reasonably benign credit environment.
Absolutely, Ruben. Thanks, Pranav. Thanks, Ruben. Maybe we have just time for one last question. As private credit looks for new frontiers, sorry, the question is from Chandrabhan. As private credit looks for new frontiers, how should the industry prepare to underwrite creative assets? What valuation frameworks or structural innovations are needed? Maybe I'll just request Umakanta for his quick perspectives. We are almost on the hour.
Yeah, I'm just reading. Can you read the question again? Sorry.
Yeah. As private credit looks for new frontiers, how should the industry prepare to underwrite creative assets, and what valuation frameworks or structural innovations are needed?
Okay. No, I think one is that there has to be a risk return parity, right? So there is never a free lunch, right? If you are underwriting a risk, okay, and there has to be a adequate protective measures needs to be built in. As I said, let's say you have these days what the collateral which you are getting in the asset light businesses, okay, so you should have probably mechanism to have charge on cash flows, okay. And as I said, let's say in case you have to do a, let's say, larger peak scenario because it's a growing business, making sure that there is you are embedding, as I said, cash sweep mechanism when the liquidity improves, and some of these things will play a role. Second, I think from I think from investor standpoint, as long as you are following a consistent process, okay, in underwriting, that I think is going to be a need of our as things are evolving.
Thank you so much, Umakanta. With that, I would like to thank the entire esteemed panel for their very insightful feedback and perspectives, and for the entire participant set for a very patient hearing. With that, I would like to hand over to Paramita for closing comments.
Thank you, Raja. Thank you, everybody. Thank you for joining.